It's great to be here today, and thank you to the panelists for joining us, and to all of you for joining us online today. So I know we've just had a bit of an introduction to each of our panelists, but I want to give each of them an opportunity to give you a little bit more background on their journey, just to introduce things, and then we'll get into some deeper dive questions on scaling their own organizations. So maybe if we could start with a round of introductions of what your company does, basic size, and how you got there, and your own involvement with the company as a founder or as a new CEO to the company, and then maybe some other ventures. I know, Nick, you're a serial entrepreneur, so some of the other pathways to take you to where you are today. So Nick, why don't I start with you?
Sure. Thank you all. I'm Nick CHANDI, CEO and co-founder of Forward AI. We are a technology company, and our technology plug into major accounting systems like QuickBooks or Xero, Microsoft Dynamics 365, Oracle NetSuite, those kind of technology companies, and we can pull data, we can push data. The way our technology works is when a bank or lender or an accountant request access to the data, we fetch the data, clean it, and deliver as a kind of single API. We can pull data, we can push data, and most of our clients, they are based in the US, Canada, Australia, New Zealand, and the UK. We are around 2-year-old company, and our focus is on solving cash flow problems faced by small businesses. And that's where the focus has been. Company is currently bootstrapped, and we have more than 60 employees today.
Great, nice. Thanks, Nick. Kelsey.
Oh, thanks, Val. Yeah. So my name is KELSEY HEIKOOP. I'm founder and CEO at Addion Systems, and our product is ProShop. And basically, our product helps small to mid-sized manufacturers run their entire business, all the way from estimating and quoting through to delivery and invoicing, with a ton of focus on creating what we call a digital manufacturing ecosystem. So that's a whole set of things that combine with training and logistics and HR and order processing and the whole works that small shops really need. And we focus primarily in regulated spaces with discrete manufacturing. So people who are building lot quantities of things as they need to for their customers in all kinds of spaces, aerospace, medical, defense, all those areas. And so we have about 75 on our team now. Yeah, it's an amazing journey. We started selling to the public in 2016. So we're kind of on year 6 of being a real company.
Great. Thanks, Kelsey. Jeff.
Yeah, thank you. Jeff Moore, the CEO of MineSense. We're a clean tech digital company that services the mining industry. Essentially what our technology does, it's a combination of hardware, software, and AI. And the mining industry is about the only industry that doesn't actually have a way traditionally to measure their raw material that starts the process. And so our hardware goes right inside these very large shovels, and we create real-time data that allows the mine to know exactly what it is that they're handling. And that makes them much more efficient, increases their profitability, and also increases their sustainability. We're now at, I think, pure scale-up mode. The product is getting good traction in the marketplace. As was mentioned, we're commercial through the Americas, and we'll be adding Europe and Africa later this year. We're currently sitting at about 180 employees, and we'll end the year at 330 is the current plan.
That's a lot of scale, Jeff. Starting today at 180 and going to 330. That's a lot of scale.
Yes, yeah, it's going to be a lot of fun, or it is a lot of fun.
Great. Thanks for the background and interest. And we've got I know a couple of have said bootstrap, and Jeff, I know you've closed a couple of rounds with MindSense, so you've got slightly different capital roads. But let's take a little bit of a deeper dive and maybe just talking a little bit about how you got to scale and how and where you see scaling in the course of the next year, particularly taking into consideration some of those capital needs, whether you think you can continue to scale on a bootstrap if that's what you're doing, or how you're going to be deploying your capital along the way. So maybe Kelsey, I'll start with you on this one.
Sure. Yeah. Well, so we definitely bootstrapped. A few founders got together and rubbed some nickels together and tried to start something. It actually came from previous experience. So we had run and grown an aerospace manufacturing company from 3 of us and 1 CNC machine up to about 75 on staff. And in the process, we'd done a lot of the engineering and design and build for our software platform. So we had a good starting point. We weren't starting from concept. We had a lot of proven technology, but we didn't have any money. Except for the nickels we were rubbing together. So we started with that, but we got into cash flow positive pretty quickly, got a lot of traction. There was definitely a lot of people who were saying that we had a product that differentiated pretty significantly from traditional ERPs and integrated much better than some of the desperate systems. And so, taking that road through the bootstrap has been interesting, scaling to where we are. Certainly heard from a lot of people that that's not particularly common to get to, this kind of size all bootstrapped. But we are looking at, what is the next years of growing 50+% look like if we're still trying to bootstrap. We got to create some pretty positive front-loaded cash flow to manage that. So financing may well be in our future.
Right. Okay, we'll circle back around to that. So hold that thought for a second. Jeff, you've just gone through, you did a successful round, but tell us a little bit about some of the milestones of scaling and growth in your company.
Yeah, I think MindSense followed more a very classic venture capital funded type of growth, and from a finance perspective, I'm actually at the Clean Tech conference in my hotel room at the Clean Tech conference, and this is where we tended to kick off our fundraisers. So when I joined the company, I already done a seed round and a small Series A, and then our next 3 rounds were venture capital finance with bringing in strategics, which we wanted to do as well to combine to get some industrial experience. But the majority of our venture capital were clean tech investors or sustainability investors, and our strategics were from the mining space. And then most recently, we've done our first growth private equity round, which means the investors we were talking to were in a different category. But also as a company, we didn't have to raise money. So in previous rounds, we absolutely had to support the cash burn in developing the product. But this last round was to accelerate growth and put more some cash on the balance sheet to accelerate that growth.
Okay. And Nick, what's your journey?
Yeah, we are also currently bootstrapped, and what happened, we had a successful exit around 2 years ago, 3 years ago now, and we built one of the largest IT consulting company that was providing services to accountants and bookkeepers across Canada and the US. So we are implementing some of the same lessons that we learned while building that company. For example, in that company, in the early days, we had a small office, and we have a phone from Shaw, and we wanted to receive calls remotely so that people can work from home. So when we founded this company, we knew from the day one, we are going to be a remote team, and we need something, a phone system that is cloud-based. So we looked at the solutions and like a Ring Central or those kind of things. So we are trying to implement the lessons that we learned, follow the playbook from the big companies, because we are trying to build a big company here as well, take over the market, because we believe there is a huge opportunity in the market for a platform that we have. there are more than 30 million small businesses in the US alone. And our product had a very unique solutions to connect those small businesses with the banks or lenders or accountants or other fintechs who are trying to serve these small businesses better.
Right. Okay. So as your companies have grown and you're at that point of scaling, and it sounds like you've got some big ambitions for the coming year. How has that changed in terms of your own leadership, and how have you had to switch your mindset from being if you were a founder, if you're stepping in, how you changed the organization, and what were those key trigger points for you of how to change your leadership style? Kelsey, let me start with you on this one.
Oh, sure. Well, I mean, it's funny because you think, oh, what's the role of a CEO? And it becomes very clear when there's 4 of you around a table and that's the entire organization, and someone points at you and says, you're probably the best person to be CEO, that role is very different than when, you've got 70 or 75 people who are looking for things like, clear understanding on strategic direction. They want to have a situation where they have confidence in the organization, and, often CEOs and others, but are the face of that confidence, are the understanding about the momentum. And so those roles change dramatically as you go. But when you're tiny, looking for inspiration from the CEO is quite often with a few of your closest accomplices in this mission, and you all have a very clear understanding. So that part of the role is very small, and you need to grow your skills in that area as you grow, but also you need to start shedding responsibilities that are very tactical and very transactional. And so for me, it was a really gradual journey. As an starting point, I had all the hats. I was the implementation person. I was, product development, product manager. I was, all the things that you can imagine, and then started hiring into those roles to try and grow myself out of those roles, but also allow space to learn and become more in the other areas. I did have the advantage of having kind of done that once already with the manufacturing company, so it wasn't all new, but it wasn't a light switch thing. It wasn't like, I'll hire somebody to take on everything I do today and that'll solve it. It's not like that. It wasn't for me anyway.
What were the first things that you wanted to fill in terms of?
Yeah, in our business, we have a really heavy implementation element, as you can imagine, with a kind of product like ours that everyone in the company will use it for multiple hours a day. So you go into a manufacturing company, they have 30 employees, and each one of them will literally be working in our product, every single one of them, an hour or so per day as part of their work, heavy on the implementation. You really need to connect with people. They're in a massive change management situation where they're changing from spreadsheets or something completely different to what you're doing, and the whole organization has to shift. So implementation was the first place I went to try and offload, because I couldn't keep implementing clients at the rate we were doing it. And so started hiring into that, and then getting someone to manage that team once we were at 6, 7, 8 people on the implementation team. That was first and foremost.
Right.
But probably the most important one that I got out of at a very key moment around employee 24 was someone to really understand and be part of our HR journey and change the fundamental paradigm of the recruiting process. Until that point, I'd been working mostly with people I already knew. I was hiring people from other parts of the industry that I was already familiar with. I knew them personally. I knew their skills. And now we needed to branch out and go much bigger, but we really couldn't sacrifice anything at that stage in terms of cultural fit and personality types and, kindness. Do you know what it's like to come to work where people are kind to you? Oh, such a big difference. Like, it doesn't matter what you're paying me. Are you kind? It's kind of like, but that was a huge and very important decision to hire a chief human resources officer. And she has been absolutely pivotal in our success to this point, to triple in size since 2020, right? So.
Right. So Jeff, you've worked with global companies. You've worked across different industries. You're obviously part of this journey with MindSense to really grow it and scale it. And so when you stepped into this, what were the first things that you saw that you thought needed to be done?
Yeah, my personal journey was a little bit different. As you said, prior to MindSense, I was running organizations that were between 350 and 2,500 people. So for me personally, it was a transition. Back when I started MindSense, we were 32 and a half is what the report said. I never found that half person. I kept looking for them where that half body was, but and so it was really what was in common with everybody is that decision of when do you add to functions, as Kelsey was describing, and very different than my previous roles where it was always growth roles, but all the functions existed. One thing, of course, as you scale up is you don't require a function until at some point you do, and that's not black and white. So when you make that call, so for us, once we started getting a product that was saleable, we had to set up a manufacturing supply chain function, for example. Kelsey mentioned HR. That was another one. When do you actually scale that up? And then there were some roles that we had people that were great in the early stages, but didn't have the same skill set we require in that particular role as we grew, as those skill sets changed. So that's all been part of the journey at MindSense.
And Jeff, did you find that with those folks that were, out of their depth a little bit in their new role, the role was requiring more, that you had success in really investing in them and getting them the skills they needed? Or was it the situation where the role was changing much more quickly than an individual could, and you ended up having to swap them for someone who had more experience?
I mean, to be honest, and I'm always very motivated to try and coach and make it work. So my board would say that I take too long sometimes to make that decision that somebody has to move out. But personally, I'd rather err on that side. But generally speaking, it would turn out that they did not have that skill set, and it's not good or bad. It's a different skill set. For example, even as you get into becoming a mature business and say grant money is less important, there's a very different skill set as you make that transition, as one example. So generally you find that it's not going to work, but we always invested to make sure that the person had a full opportunity to try. So.
No, thanks. Yeah.
So part of this, sorry, Nick, I was just going to say part of this is certainly speaking to culture, and as you're expanding, that's always hard to wrap your arms around. So Nick, maybe speak a little bit to that as you've grown. You're now 60 employees, and how do you make sure that your vision and culture permeates the organization as it grows?
Sure. Yeah, just to add to Jeff, we are experiencing the same issue right now. We have existing people and that they need to step up to the plate, but we see, one of our key person that is engaged on the planning stage before production, before any software goes into production. They're not able to step up to the plate, and even though we try to give them the opportunity. So we see it's a 6-member team, and the person who is handling it, they are not able to lead that part of the job. So what we have been discussing internally, there is another person who is way more capable because he has done the similar things. So what's going to happen, we provided the person opportunity, but if they are not able to they're not able to engage themselves in the way that works for everyone, because challenge we face is we are a fully remote team, and we are a globally distributed team, and sometimes there's a time gap. So every time any task that we define, it has to be done precisely in the way we want it to be done. We don't have the luxury of sitting in the same office where we can have a quick huddle and we can sit and talk and those kind of things. Certain things we have implemented in our remote calls is certain calls we need the person to be, like we use MS Team, one of the best tool that we implemented in our team, and it has been very helpful in keeping everyone on the same page. Is making sure when you talk, your camera has to be on in those calls, because otherwise, it was hard to see the engagement, who is proactive, who's not. So those are the kind of things, that we are thinking or working on. And just like Kelsey mentioned that, how we started scaling, in new company, because I saw my calendar was getting filled very, very quickly, and there was delay in the production. One of the key person, he was able to take so much task that he eventually became a bottleneck. And in the process we implemented, so we had to hire more people or take some of their work just to make sure they are able to work effectively. And to our surprise, one of the experience that I never had before, as it happens in any company, you have few people, key players, they move the needle and they end up taking more and more work. And this person was doing all the work, but eventually the person became a bottleneck. So we have to take some of their load, and we got some feedback that wasn't positive because person thought their value is being reduced in the company, and that was a kind of some difficult time and convincing we had to do. It's causing production delays, and it's good for our customers, good for you, good for company. It doesn't make sense that you're working 12 hours a day when at the end of the day, only thing you have is 2 hands and 10 fingers, right?
Processes are one part, people take most of the time, right?
Yeah.
So I'm just mindful of the clock and making sure that we can open up for some questions, but 2022 ended a little bit challenging for the tech industry generally, and 2023 is starting off a little bit bumpy. But what do you each of you see? Give us a snapshot of what you're thinking about in the coming short term, whether you see some upside in your business. You're all sort of geared to efficiencies, which is probably a good thing for your customers. But how do you see challenges, and how are you, if you are, retooling to try to manage that kind of environment? So Jeff, maybe I'll start with you on this one.
Yeah, I guess looking at it from 2 different points of view. So one is the market. Obviously, it depends on what your company's markets are. But I think we've all seen the signs that it's either going to be recessionary or low growth, and so I think we have to be cognizant of that and specific to our markets. With our main market being mining, the signs are relatively positive, but we are being cautious. And then the other side is on the investment side. If companies are looking to raise money, the event that I'm at this week is very investor rich, I would say. So lots of discussions on what they're seeing, and definitely there's a slowdown in capital being provided, and the trend that investors are looking more for a pathway to profitability, as opposed to in the last few years, it's all been about growth, and even if there is no profitability and there is no vision for it, like I guess the famous extreme example would be Uber, right? Just burning cash nonstop, but growing fast. So there's a shift towards looking that your business can become profitable, and that's a major trend that I think is a lot of people are talking about right now.
Right, Nick.
Yeah, for this year, and we are working on certain things in our technology, and like I shared, one of the thing we have is the cash flow forecasting and accounts receivable, accounts payable side of our technology. And key focus of the company is to review the entire customer journey, starting from onboarding, when the person sign up or they provide you access to their accounting data or banking data or those kind of things. Very important for us, because onboarding is one of the most important aspect in any app journey here. Someone said, onboarding is like inviting someone to your home. You open the door and they see, the floor is full of dirty shoes and dirty laundry, and and person has to jump across the dirty place to shake your hand. That's a very bad experience. So we are taking a new look at how our customer journey is, and improve the whole customer journey, not only onboarding, and try to nudge the customer at certain periods so that we can improve engagement and stop leakage that's happening. Try to convert these customers, these leads, and bring them into more paying customers, use or improve our APIs, uses, those kind of things. Those are the kind of things we are working on.
Right. I like your onboarding analogy. Gonna have to use that at some point. Kelsey, what do you see coming up in the?
Yeah, it's interesting times. I mean, the early pandemic times were an interesting and maybe slightly unexpected at the time, but more understandable now, where we had very large scale adoption of ProShop and in those early days. The middle half of 2020. I think what happened was many manufacturers at the sizes we deal with, kind of from like 20 employees to 200 employees, all took an opportunity to revamp systems, and they weren't quite ready to just lay everybody off because of some of the changes in the total inbound workflow. It was kind of a who knows how long this will last kind of thing, and so nobody wanted to lose a bunch of the workforce and then not be able to get them back. And especially in manufacturing, there's a little bit more buffer than if you're a sushi joint or something, and it's like, why would I have people come in to have no customers kind of thing? So there was a lot of that going on. And interestingly, what's happened is a lot of tailwinds, I think, good things happening for manufacturing, especially in the small to mid-size across all of North America. There's some good tailwinds in general. And there's still an unbelievably huge number of these kinds of companies that haven't taken this sort of modernization step and are running, on either really old systems or really poor fit systems, or literally their own spreadsheets, which aren't bad but don't scale at all. And so they're running into efficiency issues. I think that for this year we'll see modest growth in our clients and how much they're able to do that. As Jeff was talking about, I don't think most of our clients are in recessionary mode, so that's good. And certainly we're seeing some very pronounced growth still in space and some of the defense areas. There's still a lot of growth in those areas. They have longer forecasts and aren't usually as turbulent in client demand. They're far up the chain. You want to build a 747, you can't start tomorrow and crank one out by next week. So they have to really watch the longer game.
So you have some long sales lead times. Jeff, I imagine you probably do too in your industry. So you're mapping out not just 12 months of sales. You must be looking at longer forecast periods.
Yeah, for sure. And Jeff, I'm sure yours are even longer because mining companies are often humongous and there's a lot of hoops to jump through. At least the smaller manufacturers on our front. Decision makers are more available. It's like, if you have a 20-person machine shop, usually you're working with the owner and they can be like, we're doing it. In fact, we're doing it starting next month, so our sales lead times are more like 3 to 12 months for most of our clients and not much longer. How about you, Jeff? It must be really long.
Yeah, we're trying to get our sales cycle down to 12 months. There's the mining industry is very, very conservative and not the fastest moving industry. And then there is a initial installation, which is a fairly major installation with our hardware. So those factors combined. So we're probably running on average, 18 months to 2 years, but we're focusing it down to the 12 months. On the plus side, that now gives us visibility into our revenue forecast over the next couple of years. That's the flip side of that. But we're still we had all of our salespeople in from different parts of the world last week for an annual kickoff meeting. And that was one of the main messages. Like, we don't care that the mining industry is slow. We want you to go fast. So make them go faster than they're comfortable with. But it's not easy. Yeah.
Right.
But then it would be no fun. If it was easy, it'd be no fun. Yeah, not easy. And for sure, Jeff, we are trying to sell one of the largest bank in Canada. We have been working with them for almost 1.5 months and went through so many POC and this compliance and that compliance. It's part of the journey. And they were supposed to make a decision by end of last month, and now it's been extended again, and they need multi-step in approval process. Those kind of things. It's a long journey there.
Yeah. Similar experience for sure.
I was going to mention one other thing about some of the things that I think we have talked about and will continue to talk about in this session. But I just wanted to mention that the ideas that are being, talked about here, I think lots of people can resonate with them and go like, yeah, that's good. And when you were both just talking about it being hard, usually a lot of it is in the hard part, meaning it's how you show up every day. It's how you do it repeatedly. You think about your closest, nearest and dearest relationships, and you have so much invested in those and so much incentive to make that work. And we all know that some of those relationships can get strained from time to time, right? And part of that is about how we show up. And so just because we're talking about being like, yeah, we did this and this works really great, it's also hard. So for those of you out there going, yeah, I should do that too, for sure you should. But also it's hard. Doing it every day and doing it again the next day is a challenge. And I just want to say that these things we're talking about, they definitely deserve, a little leeway on your side to do your best with them.
and keeping the focus, because sometimes you can get drawn in too much and too many different areas. So we've got 35%, I think, of the attendees today are in startup mode, and another 35% are in growth mode. So we've got lots of entrepreneurs and people with high ambitions of growth. And if you had to leave them with just say one or two key takeaways of your journey and growth journey, what would those be? Nick, I'll start with you on this one.
Well, first of all, I would like to share, what Kelsey said, the same thing, startups are really, really hard, and it's a lot of work, but the best part is, way to start is, look at the planning, we put almost 60-70% of our efforts in planning before we go into any production or those kind of things. So planning is the most important part, and then is the execution. And yes, you do need a bit of luck too. And one thing what I have found is, in our case, it depends upon the market too. Like I shared with the selling to banks was a long journey, but selling to other fintechs or smaller companies, accounting firms, it was much quicker for us to do there. And we try to introduce automation, and in fact, sometimes automation is not too good either, because when you automate too much, chances of things going wrong increases as well. So we had to remove some automation and put some human element in there as well. So be aware of that when, once you have a product market fit and you have some paying people, and they're talking about you, they're recommending you, they love your product, and then it's time to grow, and just be aware of those kind of things.
Jeff, what are your key tips?
I think if I had one takeaway, it would be to keep that right balance. So on one side, you want to be visionary and you want to shoot for the moon, and for a number of reasons. One is the startup is, as everybody said, is very hard. So to motivate yourself and definitely motivate your team and talk about what that amazing future is going to look like. Definitely, if you're raising money, you have to be in that mode when you're talking to investors. But also balance that with the other side, which I agree with Nick. You have to have a plan, and the plan has to be realistic. And Val, you said it. You have to have focus. You have to choose what you're not going to do is sometimes as important as what you are going to do. And make sure that plan is realistic. So, absolutely be raw on one side, but then also just be very practical and test and see if what you're planning on, does it actually make sense? Is it realistic? Or when you're in that mode, I guess another way to say it is don't get caught up in your own PR when you're in that other mode. So.
Right.
I love it. I love it, Jeff.
Kool-Aid, but don't drink it all the time yourself, I guess.
Water it down for yourself. Got it.
Water down.
Jekyll and Hyde.
Or put gin in it. I don't know. Whichever.
That's a whole other thing. No, that's
a different
another boat altogether.
Kelsey.
Yeah, I mean, I would say that if I look back even across my career and look at some of the parts that have been, most rewarding, in some ways, I think that the times when I totally went way too big and I was like, I can do this, and came up at 50% of what I had, had ambitions for, they were more disappointing for me than, setting something slightly more attainable and nailing it, or even exceeding it. Like, you don't have to come up all the way to exactly where you said. You can always go more, and then you're even better. And I think for most entrepreneurs, and especially startups, it's pretty rare that you just like kick it out of the gate with way too low an expectation of yourself. I don't know many of those personalities that are like, you know what, we need to do this business, we're going after it. And then they set the bar at like half of what, is even reasonable. They always set it at double or 3 times. Look at your business plan, right? That you got some initial capital from, or that you made, talking of planning. How often is that plan, like, oh yeah, we're going to only grow this much. We're only going to make 15% profit. Never. It's never like that. It's like, oh, after 4 years, we're like 35% profit. That's how it always should be. So go ahead and set some great goals, but have the expectation that you can exceed those, or you can come short on those. But I wouldn't go for things that you're likely to get half of what you want. You're just going to disappoint other people. And it feels like the runaround all the time because you're working 12-hour days and coming up at half your goal. So, 50% growth for 5 years in a row is like a major home run, even though people aren't like, shouting from the top of the mountaintops about how great that is. Do the math, right? 50% growth for 5 years in a row is a lot of growth. And if you make that 6 or 7, holy cow, unless you're exiting in 2 years, think about that as an option.
Yeah, I think it's a great comment. And just to build on what Kelsey is saying, for the subject of scale up, one really important difference when you move from startup to scale up is that gap between, making my hands to work, between aspirational and you're actually going to deliver it. That gap has to narrow as you scale up. So when you're early stage, everybody expects you to talk aspirationally, but as you start to scale the company, both for external stakeholders, but also to run the company properly, that gap has to start to narrow. So you're delivering what you say you're going to deliver. And that's a really important change as you scale up.
Yeah, I think it's almost a trust issue even, Jeff. Like, people don't trust you anymore if that gap remains huge. There's a big difference between what you're doing and what you're saying you can do. People don't believe you anymore.
And you should know, you should be closer to knowing what it is as you get further down that journey, right? In the early stages, it's okay that you don't really know because nobody does actually know in the early stages. So, yeah.
And then you go through a different time too, sometime there's a deal that you have been working on and that fails at the last minute, and that's very disappointing. And other time, there's a great deal and you're popping champagne and so being aware that there will be highs and lows in the life of the company, especially in the early days, and it's very important. Don't be very disappointed, and always try to keep a level head and keep the balance. Very, very important. Don't be very disappointed and don't give up, even if the time is difficult. That's kind of mindset is also very important. So always keep that in mind as well.
That's a good reminder, optimistic and positive. So I want to make sure that that the audience pop some questions into the chat here, so that we can get what you're thinking and maybe we can address it. Got one here, which I'll open up to the panel. What's been the biggest surprise or unexpected event that you didn't actually foresee as you scaled up? What was that hiccup moment that you can identify? Anyone want to jump in on that question?
Yeah, maybe I'll start on this one. Like I shared, I worked in the accounting industry for over 20 years, and we sold from anywhere from 10 user company to 300, 500 user companies as well. But we had no experience working with the bank, and we thought, anytime you call them, send them an email, the deal is going to close within a few months. But this was a big surprise for me, and I didn't, even though I had good experience, business experience, but I didn't have the domain knowledge that we were trying to sell in the early days. And that came as a kind of bit surprise, even though now it looks normal now. But in the early days, that was a shock to me. It's going to take so long. And the compliance steps that we had to go through, I wasn't aware of those ones. There are so many restrictions like AML, KYC, and as SOC 2, those are the big issues for us.
Right, right. Anyone else have a war story or bump on the head they want to share?
I guess for us, it may be more specific, but it was on our hardware side. The spec that the company designed to was off by about 300%. We put very delicate equipment into a very nasty environment, and it wasn't off by a little bit. It was like literally 300%. So yeah, when we first went on our first actual operating shovel, the mine's equipment we go on top of, like everything broke almost immediately, which was a bit of a shock. But that was, I guess, the lesson was again, be realistic about your product specification assumptions. If there is a hardware, or well, I guess in any product, but definitely in this case, it was on the hardware side, not our data side.
Right.
Yeah, for me, I think that some of the biggest unexpected pieces were really a little bit more on the positive side, which is I didn't realize at the onset just how much fun a journey like this could be with the right people, working with the right people. I thought this was going to be a hard road, and I'd done it once before and had known how difficult that was and how many challenges that entailed. And certainly at that point, culture was less of a focus as we were building the manufacturing company than it was as we started the software side. And I have really, really appreciated how much of a difference it's made in my daily life as we've focused that extra effort on our cultural side. So that's not exactly the war story you're talking about, Val, but it was a bit unexpected in the sense that I was expecting more interpersonal dynamics and hardships between people, and a lot more conflict resolution, which I did plenty of on the manufacturing company side. But it's been great to see how well people show up for those kinds of things that always happen. You'll always have conflicts. How well people show up and handle it and come out the other side is like a game changer in my quality of life.
Yeah.
Right. So somebody in our audience has asked about investors and the comment about 50% annual growth to scale up. So the question is, how do you pitch to investors a 50% growth to scale when they expect more than that?
Sure. I talked to some VCs and I was like, so here's where we're at. We're looking at about 8 million ARR, and we're pretty sure we can do like 50 to 60% growth next year and the same the follow-on year. And they were like, oh, we kind of started 150% growth. And then, we're looking for companies that are more like 300 or 400% growth. And I realized I was talking to the wrong person. Like, this is like an angel VC. Like, we'd like to get in early and kind of ride it quickly as far as we can go. And that's okay. And there are definitely some of those. But from my experience and from their own admission, they bet on 10 companies. And they're hoping that one of those 10 is going to actually make it to anywhere useful. And the other 9, they're pretty sure are going to flame out. That's the kind of investor they are. They're literally betting on the odds. So of course they need 150, 300% growth. Now, if you're in it like that, you know what? I got 10 companies I'm going to build, so one of them is going to be a knockout. Great. But if you got one company, which is all I got, I'm not as down with that 150% growth. It's massively risky. I mean, Nick, kudos to you. 2 years where you're going, it's incredible. And obviously, you've got a lot to offer. And I know that lots of companies, have had success in that area. But it really is, by their own admission, sort of a 10-to-1 ratio when you're asking for 150% growth. It's possible you need a slightly different lender if you're thinking about the 50%, right? And 50%, like I said, for 5 years is a very different prospect for, we got to get out of this fund in 3 years. And so no wonder I need 150% growth, right? That's my comment. Yeah.
Anyone else want to comment on the investor piece?
Yeah, I mean that is the challenge. So you have 2 dimensions for investors in terms of what category investor they are. One is growth rate, and the other is size of check that they'll write. and the size of business that they will support. So on the equity side, and actually the debt side is even worse, the people that would want 30% growth or 50% growth, I think that's pretty good. They're more the private equity people, but they're investing in much, much larger businesses, the world I came out of. And the VC model, Kelsey is exactly correct. That is the model. So they're looking for, it's you know, finance 101 is risk return. Their model is that they take high risk. They're investing in startup companies that have technical risk. They may not have anything in the market yet, so there's huge market risk. So they're taking high risk, so they need a high return on that. And so if a company doesn't have the potential of a high return, then it is not a fit for VC investors. And that's exactly what their model is. They invest in 10, and you know, 1 or 2 are the home runs, and that's how they make their, like, that's literally how they do their math, and that is the model. So it's tough if you don't have that potential in your business. I agree with Kelsey that it's VCs will be maybe a tough road, but then there really is another alternative if you're a smaller company or a startup company. At least from an institutional perspective, like if you have really rich family, which unfortunately I don't, you know, that might be an option. But
well, we could put like for my first business, you know, my brother and I were partners. He took out a second mortgage on his house. That's how we started the business, you know. So who knows? There's creative financing to some degree, but with house prices in Vancouver, a second mortgage could be worth a lot to you. Need $1 million in working capital? No problem. Take the 2-bedroom and half the mortgage.
There's some personal risk that's attached to that, but I admire I admire that. Vic, anything to add to that comment?
No, I guess you know, I haven't raised the funding yet. You know, all my companies, they have been bootstrapped so far, and they have been good so far. But in the business I am in right now, we will need more capital, and we will be looking to raise hopefully sometime later this year. So we'll be in the market, but I understand, you know, what Jeff and Kelsey said. This is my understanding of the market too. You know, the companies or VCs who are going to bet on us, you know, they would like us to grow really fast. You know, maybe they want 50% quarter to quarter kind of growth. You know, that's the company they want to see, or maybe month to month. I have seen, you know, and the product we are working on, you know, those kind of things are possible because market is huge. You know, there is a good opportunity too.